Welcome to the Money to the Masses podcast, putting you in control of your finances. It's a good thing podcasts are free, as this one isn't worth a penny. Here are your hosts, Damien Fay and Andy Leaks.
Now, Damien, before we get on with this week's podcast, you had something quickly to say about our sponsors.
Yeah, we've got a new sponsor, Money Farm, and Money Farm are an online investment advisor and one of the biggest digital wealth management companies in Europe. So a big thank you to them for sponsoring the podcast. Now, Money Farm create portfolios to maximise long-term returns using ETFs to make incredibly cheap portfolios. And you even get the first £10,000 of your portfolio invested without any charge from Money Farm. And if you enter the code MTTM20K into the box when you sign up, you get the first £20,000 of your portfolio invested and run by moneyfarm.com without any charge.
Great stuff. On with this week's show. Hello and welcome to episode 116 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leaks. Damien, how you doing?
I'm good, Andy. It's good to see you, actually. It's been a hectic week. I've been talking a lot because you remember last time I was chatting about the new podcast I'm doing about inspiring people to take a great leap into the unknown and follow a passion and change their lives. Well, I've been doing various interviews, so I feel like I've spent the large part of this week talking, so it's good to be back to relative normality of just chatting to you, Andy, to be honest with you.
And of course the thousands, the tens of thousands of listeners that we have as well.
Yeah, and the tens of thousands, I don't forget them, but obviously looking at your smiling face, Andy, is enough to brighten my day. So how's your week been?
My week's been alright, yeah. My wife had a bit of an accident. She put her back out a week or so ago, so we've had a week's worth of rest and tablets and chiropractors and me having to do the school runs. So,
I was going to say it's a shame to hear. The way you said we've had a rest, it made it sound like you decided to have a lie down as well in sympathy and just have a rest.
No, it's quite the opposite. And do you know what? I think it's good for husbands to actually get a little slice of reality from time to time. And actually, I have to hold my hands up and say I don't think I fully appreciated just how busy and how tough my wife has it. So, yeah, put that on record. She does a blooming good job, and hopefully she'll recover soon.
I tell you what, Andy, I hope she does. I know what having a bad back is like. I had one previously when you end up having a slight sport injury. Nothing major, but it's so limiting. And so let's wish your wife a speedy recovery. But apart from you having to do everything, be super dad and super carer, you've been all right.
Yeah, I haven't managed to fit anything else in, and that's kind of what I was harking back to, the fact that she's Superwoman, so well done her. Anyway, that's enough about me. What have we got coming up on the show this week?
Right, we've got 3 pieces this week, and they are, 2 of them as usual have been inspired by national newspapers asking me about topics this week. So one of them is, as we are heading into the new year, a good theme is one way of trying to boost your finances by making sure you're claiming various tax reliefs that are available to everybody out there. And I was asked what are the best ones, or any that people don't claim and should be claiming. So I've pulled together a short list of some of the key ones. So I'm going to run through that. The New Year part is irrelevant. This is an evergreen piece because it can be doesn't matter what time of year you're going to do this. The other piece I was asked about was to do with interest rates and how do you know when they're going to go up. So the bank base rate has hit a historic low and was cut in the summer of 2016. And how do we know when it's going to go up? Because the only way it looks like it's going to be up. So I'm going to give people a couple of tips. And there is one fairly timely piece around tax returns. I just want to quickly talk about filing tax returns, just who should be doing it, and just giving people a little bit of advice to make it that smidging easier than it is. Because if anybody has tried to do a tax return online, then it is a bit of a minefield. So those are the 3 pieces, Andy. Take your pick as to which we're going to do first.
Let's go for the tax first. Let's do the taxing bit first.
Well, let's do the tax because tax is boring, okay? So we can get it out of the way and get onto the more interesting stuff. Now, what I want to just quickly run through is who needs to do a tax return, because there'll be people listening to this podcast who think, well, should I be doing one or shouldn't I? Because no one tells you to do a tax return. You have to go and register online and actually decide that you're going to file one. So if you are self-employed, you should be doing one. If you're a company director of some kind, then you should be possibly doing a tax return. If you have any other form of income, even if you are employed and you're paid via PAYE, which is the code system that you actually pay your tax if you're employed. So if you have rental income or you have some other income from somewhere else, then you will need to file a tax return. And if you receive child benefit and you or your partner earn more than £50,000 a year, then you need to file a tax return in order to repay your child benefit. Because if you recall that if you earn over £50,000 a year, your child benefit is actually reduced on a tapered scale until it's completely removed by the time you get to £60,000. So if you earn, one of you earns over that amount, then you have to pay it back, and the way you do that is via a tax return. So that is who has to do a tax return. Now, I just want to quickly run through how you do it.
Yeah, let's do that. You might actually be helping me, because I've been doing a tax return ever since I had a book that went on the internet, and I started earning some additional money. And as you said earlier, no one really tells you you've got to do these things, and no one necessarily tells you you're doing them right unless you pay lots of money for an accountant. And to be honest, the extra earnings I was earning didn't really mean that I had enough money to pay an accountant, so I was kind of winging it, and in a way I still am. So I'm hoping that you're going to give me a few tips.
Okay, the tips I'm going to give are going to be how you get started, and actually when you go through the step-by-step process, there's help along the way. You mentioned a tax consultant or an accountant. Now, one of the big tips, if you're going to get confused doing any of this, then get somebody to do it for you, because the one benefit, if you did get somebody to do it for you, as in an accountant, then you won't have the tax man chasing after you for not filing a return or doing things wrong, and that will cost you about £150 for somebody to do your tax return. So you can weigh up the balance of whether that's good or value or not, whether you do it yourself. You can do it yourself. If your income is relatively straightforward, then it isn't the hardest thing in the world to do. So the hardest thing is actually getting started, because what you need to do is you need to go to the official site on the hmrc.gov website, and it's got a /registration is the URL. Andy will put a link to it in the notes of this podcast. Somebody got in touch actually recently and asked if I could repeat all the URLs twice, because people write notes as they listen to the podcast and sometimes they miss them, but we do put them in the show notes, so that's the easiest way to get them. When you go to the website, go to select individual and then go to self-assessment, and then you fill in the details that it asks you there about you personally. What will happen is you will get a user ID assigned to you and you create a password. Now, the key thing is you then get an activation code, which is
sent once in the post about 2 weeks later, and it's a one-time deal, and it is so frustrating.
Andy, you just hit the nail on the head. And if you could see Andy there, he was clenching his fists when he said that, because I know that frustration. Because they send you an activation code, so you think, oh, I need to go on and file your return. I should jump back slightly, because there's a deadline for all this, okay? You need to get your tax return done for the 2015 to 2016 tax year. It has to be filed online by the 31st of January 2017. So when you do a tax return, it's always the January after the tax year has finished. That's the one where the income you're looking at. So it's not the one you're currently in, it's the one that had finished in the April previously. But of course, as Andy said, what happens is everybody suddenly realises, I've got to do this. They register online, they get a username and password, but they get this activation code that comes in the post, and it usually takes 7 working days, which that is more than a week, because obviously it's only 5 working days in a week. But you only get it by post, and like Andy said, it's like a one-time only thing. You need that to be able to get online and complete the registration. And if you don't have it, then you can't do your tax return. But of course, anybody who's listening to this is thinking, hold on, so if I get to the 30th or 31st of January and try to go online to do this, you won't be able to. And what will happen is you'll end up filing your tax return late. And if you do, you'll get a £100 fine regardless. And now that can increase over time the longer you take to file your return. So the reason I've done it this week on the podcast is just to remind people that if you think you're going to have to do a self-assessment tax return, then check. And if you do, then do the registration process, because you're not going to be able to do anything for over a week. Right, so assuming you've got through, then what you need to do is gather all your paperwork together. So you need to get your P60 forms from your previous employers, which shows you sort of income and tax. If you've left a job, then you need your P45. And again, this is for the previous tax year to the one that we are currently in. So it's 2017 now, we're talking 2015, 2016. If you had any benefits and expenses that have been paid for you, then you should have a P11D or a P9D. Now this is all probably music to Andy's ears, being an accountant during his daytime, but for most people you would have got one if you have received any of those benefits. Remember, you need to know your bank account interest and your dividends and any income that you received in that tax year. Now for most people it's nothing, so when you go through you have to actually put in zeros for a lot of this stuff. But if you've got any income, then put it in where you should do. It's fairly self-explanatory. Make sure you put any expenses that you've got in there, and there are a number of legitimate expenses and costs you can reduce your tax bill by. Again, you'll see them listed. And if you work from home, you can claim the cost of running your home and your business expenses. So the HMRC website does have a list of this stuff. I'm not going to run through it on the podcast bit by bit, because it'll be boring and we'll be here all day. But if it is complicated, then do speak to an accountant. Like I said, it's going to be £150. One big tip is once you go through the process, you get a chance to check it. And the summary at the end is far simpler than the process itself. I've done it and I've gone through and looked at these things. So you get a summary where you get the form printed out, which is your tax return, as it were. So the actual bit you go through is like it's like a funnel, it's like a workflow that goes through that pre-populates the form. Otherwise the form is quite difficult to complete. Therefore that summary you get at the end is very easy to actually review and look at. So don't worry, you can go back, you fill in a question, you get to the end, you can save it, you can go back and you can change it. So do that if you're not sure whether you should answer a question yes or no, or any details, and you can see at the end the summary should match up with the information that you started with on your paperwork. The last tip is, when you've finished, make sure you actually go and pay your tax, because you may think you have somehow paid it, but you won't. You actually have to go and pay it via your bank account, and a lot of people forget to do that last bit. They actually finish the tax return, they click done, and they see their bill, think, fantastic, happy days. Even though you finish the form, make sure you go to your online banking and pay it, and make sure you also check the HMRC sort code and the bank account number that you put it, because they have actually multiple different ones, and you could end up paying it into the wrong one when you use your internet banking if you just type in HMRC blah blah blah, because they do try to preempt you, don't they? Your online banking does try and help you by pre-selecting bank accounts that the bank already knows exist, and the HMRC is one of them. So make sure you send it to the right one. I've heard many stories of people who've done that, sent it to the wrong bank account, and then they have all sorts of issues trying to unravel it. And the other thing, just a quickie, if your bill is over £1,000, then you may have to start making what they call payments on account towards your tax bill for the next tax year, i.e. this tax year, which will be half of what your bill is for the previous tax year, if that makes sense. Don't worry about it, because it will tell you when you go online, but it may mean you end up paying a little bit more than you think you're going to, than the numbers you've worked out on your piece of paper before you even started your tax return, but it will tell you. So make sure you do your tax return early, because if there is an extra payment you need to make, you're going to need to find the money.
And the good thing about that, in a way, is yes, you might have to pay more now, but of course when you do your tax return the following year, if it turns out that you should have paid less because you're kind of paying it forward, they may well tell you that you've actually already paid over the odds, and so you might actually get a bit of a rebate the following year. So it's not all bad news.
Exactly, Andy, because all you're doing is they're trying to get the tax ahead of time. If you hear some weird knocking, by the way, I think I've got some work going on in the building next to me, so you probably might hear that come through. Ignore it. It might be irritating, but ignore it.
Good stuff. As you were kind enough, Damien, to let me choose the first one, why don't you choose this next one?
Okay, the next piece I'm going to do, Andy, is tax reliefs people could claim and boost their income. Now, I was asked this by a journalist, and there are a number of tax release we can do. Or not all of them are tax release, some of them are almost taxes, but allowances we should be checking we can use. So I'm going to go through them, and people, you can Google them or go onto the Money to the Masses website to find out more information. So the first thing we should do is check your benefits that you might be entitled to. People are surprised that there are benefits out there that they may be able to get that they're not claiming. Now again, I'm not going to run through them all because there is an easy way to find out. And there is an official online tool called Entitled To on the .gov website that will, if you put in your details, it will tell you of any credits, tax credits or benefits that you may be able to claim. So go do that ASAP, because there may be some free, inverted commas, money that you could be entitled to. The other thing to check is whether you are entitled to the married couples allowance. Now, this marriage allowance is a new allowance that was brought in the last year, where 4 million people are eligible to be able to transfer some of their partner's unused personal allowance, their personal income tax allowance, if it's not used, to the main breadwinner. And the problem is that all these things is a great idea, but only a quarter of the people entitled to. We did a podcast on it before where we cover it in more detail, but 3 million people don't actually claim it. And now this could be the equivalent of £220 less tax that you could pay if you claim this. So if you have a partner who isn't using all of their personal allowance, so they're not earning more than £11,000 a year, you may be able to transfer some of that and use it yourself. There are rules as ever and caveats that stop everybody doing it, but double check. You might be able to get a council tax rebate. That might be able to put some more money back in your pocket, because just very quickly, the way council tax bands work, our houses, we pay tax based on the band we're in, and everybody in the street is usually in a similar band or the same band, depends on the type of house. And back when they were when council tax was brought in, I think it was in 1991, all that happened is someone went down the street in a car looking around and kind of valuing the houses and saying, yeah, they're all the kind of same and they'll be in this band. And that has been pretty much how things have been static and ever since. So the amount you pay has been determined from nearly 20 plus years ago. You can move bands, that's the thing, and as houses change or improve, made bigger or whatever, then they can change band, and that dictates how much council tax you pay. You can appeal though, so you can go online. If you go onto the Money to the Masses website and type in council tax, you will find an article where I explain how you can look to check your council tax band is A, correct, and B, you can challenge it. It's in the 30-day money plan book as well, if you want to go and download that for free. Listen to the end of the podcast where I tell you how to do that. But basically, you can look what everybody else is on in your street, and then you can challenge the local council, and it's free to do, and you could actually have your band changed and you could pay less tax. The interesting thing is though, beware, because there have been cases where rather than your council tax go down, your neighbours goes up. And there was one story I remember seeing where the whole streets went up because one person appealed. The other thing is you may be able to avoid a TV licence legally. Now, BBC iPlayer used to be didn't require a TV license if you watch that. The simple thing is, if you watch live TV, you need a TV license, but if you watch catch-up TV, then theoretically you don't. But BBC iPlayer, if you use that, however you use it, you do require a TV license. So if you're only watching catch-up on things like Channel 4, etc., you don't need one, and that can save you £145.50 a year. Check your tax code is a big one, because 1 in 3 people apparently are on the wrong tax code or have been on the wrong tax code. An easy way to do this is if you go to a website like listen2taxman.com, that's listen2taxman.com, which is a PAYE calculator. So if you're employed, you can put in your gross salary and it will tell you what your net pay should be. Very simply, get that figure, look at your pay slip. If they match, then you're probably on the correct tax code, because that assumes the default tax code on the calculator. Pay money into your pension is another good idea if you can afford it and you don't mind locking your money away till you're 55, because you get tax relief on that money. So if you're a basic rate taxpayer, you get a 20% Brucey bonus. So in effect, a £100 contribution only costs you £80. That is a good way of boosting your investments and your pension. You can also pay into a spouse's pension, or the spouse can pay into it. If they don't even earn money, because even if you don't have any money, any income at all, you can pay up to £3,600 in total, which includes the tax relief. So I think that's 2,880, I think, if you work it back net, and they can get the tax relief to take up to 3,600. Now, wealthy people do this because they think, well, do you know what, I might as well use their tax relief as well. It's free money because you're getting a 20% buffer. Whereas with pension contributions, it's reclaiming tax. Well, if you never paid it because you're not earning, you are definitely getting free money there. So that's not a bad thing to do if you are planning to pay into a pension for them anyway. Make sure you use all your tax allowances. Now, everyone has a personal income tax allowance, which currently, as I do this podcast, is £11,000. I have a capital gains tax allowance, which is £11,100. A savings allowance, which is new, which is £1,000. So that's how much interest you can get without paying tax. And there's a dividend allowance, so income that doesn't require tax if it's from dividends, which is £5,000. Now, if you add all that up, that comes to about £28,100, I think. Which means if you adjust all your income, so you're getting income from whether it's employment up to 11,000, maybe investments, that's capital gains, that's a bit more difficult to do, and dividends and savings, you could theoretically get £28,100 a year without paying tax. And as a couple, you can double that figure. So that's the theory. And our financial planners will try and do that for their clients. So I'm just giving you a hint of what happens if you go and see an IFA. Make sure you use your spouse's allowance, whether it's ISAs or all of those allowances. An ISA allowance, obviously, you can put stuff in there, whether it's savings or investments, and they can be tax free. And the other thing is, consider joining your employer's share save scheme, because it's I really like them. It's a great way to reduce your taxable income, because you basically get shares in exchange for income, don't you? And I don't know if you ever had one, Andy. I did years ago when I was in one. And you're not liable for income on those things. It basically goes in there tax free, and you only have to pay capital gains tax on the sale. So it's a really good way of getting cheap shares, because you also get them normally at a reduced rate. So it's a great way of saving. If you want to come out of them early, then you normally just get your money back, maybe plus a bit of interest. But it's a good way of getting shares in the business you work for on the cheap, which you can then sell at a profit at a later date. And it's a way that employers try and not lock people, but incentivize them and help them to make money from the business being profitable. The final one is childcare. There are childcare vouchers which you can have, and I've used in the past, which are incredibly helpful. They really mean you can get they subsidise your childcare for your children, because they allow you to really pay for childcare out of gross pay. That scheme is changing. There is a new one that's due to come in this year, which isn't out there at the moment, but keep an eye on it. But have a look at childcare vouchers. And the other thing is to make sure you're claiming your free hours for children aged between 3 to 4, because you can have 570 hours of free education for children of that age, which works out to be 15 hours a week. And some people don't claim it. They might not want to put their kids into nurseries or whatever, but it's great, obviously, for mixing with other children. We did it. Don't forget, it's free, and that scheme is being extended to more hours, so do have a look. And so all of those things, there will be others. If there's any others that you can think of very quickly, then ping them in and I'll post it onto the site and Twitter feed as well. But they're the very quick, easy, dirty ones that can actually mean you save a bit of money. Right, and the last piece, which will be is about interest rates. Now, we're not going to dwell on this, but I was asked whether when interest rates will go up, and the thing is, we don't really know. Well, funnily enough, at the end of 2016, the market thought that rates would be cut, and that was partly because the Bank of England had kind of led people to believe that would be the case. It didn't happen. So when I was asked what's going to happen to interest rates in 2017, the simple answer at the moment, everybody thinks the market is pricing in that nothing will happen, and 2018 may be the point where they start to go up, but they're going to go up fairly slowly. To give that some context, though, for the last 7 years, the market has been pricing that they will go up, and they clearly haven't. What I want to do is just check out a couple of things for people to look at. When you're watching the news, you hear about inflation. If the inflation keeps going up, then there's more chance that interest rates will have to go up, because interest rates counter inflation. We've done a podcast on it in the past. Have a listen. But in simple terms, if inflation gets too high, then the Bank of England will raise interest rates. They're targeted at 2%. as the level they need to keep it at. But we're well below that at the moment. But there's a very big likelihood that we're going to go above 2% in 2017 because the pound has fallen so much. So everything we import is more expensive relatively. So that means things will go up. And so inflation is a measure against the previous year, don't forget. So compared to last year, which would have been pre-Brexit, and the pound falling 20% against the dollar, things will become more expensive. So keep an eye on inflation. If employment keeps falling and economic growth keeps edging up, then there's a sign that interest rates could go up sooner rather than later. Certainly more likely that than they'd be cut or anything else. The one thing I would say is we have no idea, but Mark Carney in 2015 started dropping hints about all people should get used to the idea that rates might go up, because at that point they really did think interest rates were going to go up in 2015. They didn't in the end, but at the time the market had priced in they would. Mark Carney was sort of dropping hints because the Bank of England don't want to shock the system, because if they raise interest rates it means our mortgages go up, it means that there's less money sloshing around the economy, and it means economic growth will start to could possibly slow, and they don't want to cause the economy to stall before it gets going, so they try and give hints that that's what's going to happen so people can adjust gradually. So listen to Mark Carney's comments when you watch the news at 10 and he's on there doing press conferences and stuff like that, whether he starts mentioning rate rises. If he starts mentioning it more, then there's a hint that the first rate rise will be sooner rather than later. Again, quickly, just a hint where we were last year, back in the last year after the rate cut in 2016, the market wasn't pricing in a rate rise until 2019. And now that's probably come forward a bit, and that's partly because America are raising their interest rates, and the whole system's inadvertently linked because of inflation, etc., etc. But they're the key things to keep an eye on. Listen to what Mark Carney says, but don't bet your house on it. Right, that's us done for this week, Andy.
Excellent. Anything else to mention? I suppose stuff from my side, as always, is please do let people know if you enjoy the podcast. Spread the love, spread the word. Give us a review if you haven't already. At the very least, you could be in with getting a free book from Damien that's worth £4.99. And the guy at the end of the podcast tells you how to do that. Damien, how do you get in touch with you?
If you want to get in touch with me, then it's damien@moneytothemasses.com, or you can get me on Twitter @moneytothemasses. And thank you for your emails that have been coming in about how much you're enjoying the podcast. Remember, leave a review. I love getting your emails, not because I love self-praise or anything like that, but it gives me a real momentum and energy to keep doing what we're doing, and it gives me a sense that we are really going places, because 2017 has started off in an incredibly exciting fashion for us, and I'll have more details on those things in the future, so keep listening.
Good. Until next week.
Until next week. Bye.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.